Hello, everyone, and welcome back to English Pod. My name is Marco.
My name is Catherine, and today we've got an upper intermediate level lesson for you all about money.
That's right. We are going to talk about the stock market. So a very interesting topic, very current as well, because, well, throughout the world, stock markets are not doing very well.
That's right. And you may have seen on the television a lot of information about this. So today we're going to hopefully explain some of the things and phrases and words that you've been hearing. But first, we've got a couple of important indicators, a couple of acronyms, actually, that you're going to hear about. So let's look at those in today's vocabulary preview.
Vocabulary preview.
All right, so the first word that we have on vocabulary preview is the NASDAQ. NASDAQ.
NASDAQ. So this is basically the American stock market.
Right. It's an acronym. Now, it's a really, really long acronym, so we're not going to get into it, but it is basically the American stock market where all these companies are trading stock. Publicly traded companies.
Great. So publicly traded companies, you're basically trading their stocks through NASDAQ.
Right. And now the next one that we have is an indicator which tells us how well some companies or some stock are doing, and that's the Dow Jones indicator.
Dow Jones indicator. So maybe if the Dow Jones is really low for something, we think, man, it's not doing so well.
Right.
If it goes up, things are improving.
Right. So usually the Dow Jones it's based upon the 50 biggest companies in the United States, the 50 biggest publicly traded companies. Now, you can divide it into like industrial companies or pharmaceutical companies, etc. But in general, that's the indicator and how it works.
Great. So let's take a listen to today's dialogue and find out how these words are used in context. And we'll be back in a moment to talk about what's going on.
Sorry to bother you, sir, but I have some bad news.
What is it?
Well, the stock market just took a huge plunge and we've lost a lot of money.
What do you mean? What happened?
There are many factors that weigh in, but NASDAQ is down 200 points. The Dow Jones indicator also suffered. Our portfolio is worth half of what it was worth 1 week ago.
How is this possible? You are supposed to be talking to our stockbrokers and making sure that our securities and investments are safe and making a profitable return.
I know, sir. We didn't expect a bull market to become a bear market all of a sudden. On the other hand, you still have some high-yield trash bonds and government bonds that will give us enough liquidity to cut our losses and reinvest in emerging markets. We could potentially make this tragedy work for us and make us think outside the box.
Do what you have to do. One other thing, don't tell the rest of the stockholders about this. If they find out, it's the end of this company.
All right, we're back. So a lot of interesting words there. I think a lot of them were very specific to the stock market and very, maybe a little bit difficult. So why don't we take a look at a couple of those and language takeaway.
Language takeaway.
Okay, so this first word is a very important word in banking and finance. We talk about portfolios a lot. So portfolio.
Right. So basically a portfolio is the variety of things that you own. For example, in the stock market, it could be stocks, it could be bonds, it can be mutual funds, etc. Or, for example, if you're a company, your product portfolio could be all the products that your company owns.
That's right. So in this case, our portfolio is worth half what it was a week ago. And so this is a sentence that means, we've lost half of the money we invested.
Right.
All of our investments are in a portfolio. We talk about them as a portfolio. And when we lose money, we mean we say our portfolio is worth less now than it was before.
Exactly. And well, moving on, he starts to talk about the bull market and the bear market. So what is this all about?
Well, a bull is an animal with horns.
Right.
And a bear is another animal. So we're not talking about animals here.
Right.
We're talking about special finance phrases.
Right. So the bull market would be again, talking about companies and trading. It would be maybe a market that's growing very rapidly, that's very, very strong. That's a bull market.
So people often talk about China's bull market, right?
Right.
How China continues to grow and grow and grow and grow. But a market that slows down, like the United States last year, would be a bear market.
Right. So think of a bear. Maybe it's sleeping. It goes it's into hibernation. That's a bear market. So a slow market. It's not really growing.
Very good. But talking about a portfolio again, we might have stocks, but in this case, the two people are talking about their bonds.
Right.
So he says you still have some high yield trash bonds and government bonds. What's a high yield bond and what's a trash bond?
Okay, so when we think about the word yield is how much it gives, right? So how much we are getting from it. So something that is high yield means that you're getting a lot from it.
For example, this orange tree yields 300 oranges per year.
Okay,
That's how much we get from it.
Exactly. So we're getting 300 oranges. That's how much it's yielding. And so so basically that's what yield means. So when we talk about trash bonds, this on the other hand, it's a word that's maybe a little bit tricky, but a bond is a promise that you get from the seller that he's going to pay you back the money that you give him with interest. Right? But a trash bond is a very risky bond. It means that the seller might not pay you back because, he's still trying to get all the money.
All right, but a high yield trash bond means that you might make a lot of money from this bond, unless, of course, it's not very dependable.
Exactly. So
It's risky.
of course, since it's riskier, it has more yield.
Great. So high yield trash bond. And then what about this? They will give us liquidity to cut our losses. Liquidity. We hear all about liquidity in finance.
Exactly. Maybe in your company, the accountant will talk about this. And that's basically just to have money, cash in hand. So you have money to pay things or to buy things, right? Not
Okay,
with
so it's available.
available, yeah. Not with credit. The opposite of credit.
Okay, liquidity. And finally, instead, what are we going to do? Let's think outside the box. We could reinvest in emerging markets.
And this is a very hot topic lately, talking about emerging markets. So to emerge means to come up, right? To rise.
Yeah, to come out. So it's almost like new or growing markets. So in this case, an emerging market would be, for example, the Southeast Asian market, which is growing quickly, or even you could say West African market. We're talking about places in the world that aren't established. They're not old and dependable. They're new and exciting.
Right. So they're coming up. So that's an emerging market. So a lot of very interesting words and phrases. They're very related to our topic. And so why don't we move on now? Let's take a look at two key phrases on Fluency Builder.
Fluency Builder.
This first phrase is something we've heard a lot about in the last year or two with things not going so well in the world of finance. The first one, here we go, to cut our losses.
Okay, so let's cut our losses. So when you talk about cutting your losses, that means to try and stop losing money somehow. Maybe sell early.
That's right. So in this case, we're losing money. Let's stop now. Let's stop
Right.
everything. Cut our losses. That means cut them away, forget about them, throw them away, and start again. Okay, so we could say, my business is failing. I'm going to cut my losses, sell the business, and start again.
Right. That's exactly it. So to cut your losses means to stop doing something, maybe sell it, and stop losing money.
Basically, you accept the fact that you lost it. You can't get it back, and you start
Right.
again.
So when they were talking about investing in emerging markets, he said, well, maybe we could do this, and that would force us to think outside the box.
Okay, this is a great phrase, and you might hear this in meetings a lot or from your manager. What's going on here is these two people are talking about how they lost a lot of money. The economy is bad, and they've been doing things in a normal way for a long time. It's not working. Let's think outside the box. That means let's be creative. Let's try and discover new ways of doing things that will yield positive results.
That's right. This is a very, very common phrase, very widely used in business or when you're talking about ideas is people tell you to think outside the box, to maybe break some of the rules, right?
Right. Don't just think the way that you always do. Don't do the same thing over and over. Do something new, be creative, come up with something great. So that's thinking outside the box.
Right. Very good. So a lot of great phrases there. I think we've learned quite a bit. Why don't we listen to the dialogue one last time, and we'll be back to talk a little bit more about this very interesting topic.
Sorry to bother you, sir, but I have some bad news.
What is it?
Well, the stock market just took a huge plunge and we've lost a lot of money.
What do you mean? What happened?
There are many factors that weigh in, but Nasdaq is down 200 points. The Dow Jones indicator also suffered. Our portfolio is worth half of what it was worth 1 week ago.
How is this possible? You are supposed to be talking to our stockbrokers and making sure that our securities and investments are safe and making a profitable return.
I know, sir. We didn't expect a bull market to become a bear market all of a sudden. On the other hand, you still have some high-yield trash bonds and government bonds that will give us enough liquidity to cut our losses and reinvest in emerging markets. We could potentially make this tragedy work for us and make us think outside the box.
Do what you have to do. One other thing, don't tell the rest of the stockholders about this. If they find out, it's the end of this company.
So I remember being a little kid and watching TV with my parents, and on the news there was always the business segment, and in this you'd always hear the Nasdaq is down 10 points. The Dow Jones Industrial today is down 10 points. Yesterday was up 2. That's an average of 8. Okay.
Yeah, it's very complicated, especially if you take a look also in the newspaper. Sometimes it shows you different publicly traded companies and it has a bunch of numbers. It's a very interesting topic. It's almost a science, I think.
Very much a science, and some people have made a lot of money playing the stock market and trying to buy stocks when they're low, wait until they're high, sell them off, and make tons.
Yeah, it's pretty much analyzing risk, so making calculated decisions, and that's why they use all these formulas and all these different ratios and ways to ponder how much they should invest or what would they gain, and so it's very, very interesting. Many people compare it to gambling, but it's kind of like gambling, but not really, because you don't really depend on luck. You kind of make calculated decisions.
And sometimes you're trading for big companies or even parts of big markets, like parts of entire countries' businesses. Yeah, so
a lot of people, for example, stockbrokers will invest a group of workers' retirement funds. They will take those funds and be like, hey, you're maybe getting 5% from the bank for keeping your money there. Give me the money and I'll give you 25% yield on your investment. So so obviously they're playing not only their reputation but also with other people's life savings.
And that's why a lot of people lost money when 2 years ago the bubble really burst in a lot of areas like real estate. Stock prices went down. The United States went into a recession, and all these people's retirement funds, their savings, they lost it. And so you got to be careful with this kind of stuff and do your homework.
In modern society, with economic globalization and the continuous innovation of financial instruments, borrowing money has become an indispensable part of many people's daily lives. Whether it is to cope with unexpected emergencies, finance an important investment plan, or resolve short-term cash flow issues, borrowing offers flexible financial support. However, borrowing is not merely a simple monetary transaction. It involves a range of complex responsibilities, risks, and management measures. When opting to borrow, individuals must clearly understand the fundamental components of a loan, such as the principal, interest, and repayment methods, and appreciate the critical importance of timely repayment, sound budgeting, fully comprehending loan terms, and maintaining a good credit record. Only with a thorough grasp of these basic concepts can one avoid potential pitfalls such as exorbitant interest, debt accumulation, credit damage, or even asset seizure, thereby ensuring the effective use of funds and safeguarding financial health. In the financial market, the act of borrowing is often vividly described as renting money, emphasizing the temporary and contractual nature of the relationship between borrowers and lenders. Whether one obtains funds through bank loans, credit card overdrafts, online lending platforms, or private loans, borrowers must weigh the pros and cons of each option based on their individual needs and repayment capabilities. Bank loans are typically known for their lower interest rates and stringent approval processes. Though they require detailed financial documentation and collateral, credit cards provide a more convenient borrowing method, yet their high interest rates and late fees can be a constant source of concern. Meanwhile, online lending platforms, which have surged in popularity in recent years, offer unique advantages in convenience and flexibility, though some may lack robust regulatory oversight and risk controls. Consequently, choosing the most suitable borrowing channel and product is a critical decision that must be made with careful consideration. At the same time, the responsibilities and obligations inherent in borrowing constantly remind every borrower to treat their debt with a responsible attitude. Timely repayment is not only a basic contractual requirement, but also directly affects one's credit history. A solid credit score is essential for securing more favorable loan opportunities in the future, whereas delays or defaults can lead to steep penalty interest, a decline in credit ratings, or even legal actions for debt recovery. For this reason, borrowers need to devise detailed repayment plans and manage their income and expenses carefully to ensure that every loan is repaid within the agreed time frame. Moreover, reading contract terms thoroughly before borrowing and fully understanding interest rates, fees, penalty conditions, and any additional clauses are crucial steps in avoiding unfair lending traps. Only when borrowers are fully informed about the relevant details and risks can they enter into loan agreements with confidence, thereby preventing unnecessary economic burdens caused by information asymmetry. In fact, improper borrowing can often trigger a chain reaction that plunges individuals or families into financial crises. Exorbitant interest can continuously increase the repayment burden, and the accumulation of multiple loans can result in a snowball effect, turning what was initially a short-term cash need into a long-term financial predicament. When debt reaches a critical level, it not only disrupts daily life, but can also damage one's credit record, thereby hindering future access to financing and even affecting employment opportunities. In extreme cases, borrowers may face the risk of asset seizure, further deepening the financial crisis for the entire household. Therefore, borrowing is not merely a matter of cash management. It is a financial management practice that must be approached with seriousness. Borrowers should objectively assess their repayment capacity before borrowing and avoid impulsive loans driven by temporary cash shortages, thus steering clear of a debt spiral induced by chasing low down payments or high loan limits. Furthermore, with the rapid development of financial technology, an increasing number of tools and platforms have emerged to assist borrowers in managing their loans and repayment schedules more effectively. For instance, various accounting software, automatic repayment reminder services, and smart budgeting tools help borrowers monitor their financial status in real time and promptly correct overspending behaviors. While utilizing these tools, borrowers should also regularly review their personal credit reports to ensure that no inadvertent errors or misinformation harm their credit standing. At the same time, financial institutions and regulatory authorities are continuously refining policies and regulatory mechanisms to promote lending convenience while preventing excessive borrowing and mitigating financial risks. This collaborative approach not only creates a more transparent and equitable financial environment for borrowers, but also contributes to the healthy and stable development of the overall financial market. In conclusion, while borrowing is a common method for managing cash flow, providing short-term financial support for individuals and families, it can also lead to long-term financial risks if mismanaged. Throughout the process, borrowers should remain clear-headed, objectively assess their financial needs and repayment abilities, choose appropriate borrowing channels and products, and strictly adhere to contract terms to ensure timely repayment. Only by doing so can they enjoy the benefits of borrowing while effectively avoiding risks such as high interest, debt accumulation, and credit damage, ultimately achieving both efficient fund management and sound financial health. As borrowers increasingly recognize that borrowing is not merely a short-term solution for cash flow, but also a long-term practice in credit management and financial planning, they are beginning to pay greater attention to every management aspect throughout the borrowing process. First and foremost, borrowers must cultivate the right mindset regarding repayment, understanding that timely repayment is not only a basic contractual obligation but also essential for building and maintaining one's credit history. Consistent, on-time payments can steadily enhance credit scores, laying a firm foundation for future large-scale or preferential loans. Conversely, any delays or defaults can result in hefty penalty fees and even legal actions, potentially trapping one's finances in a vicious cycle. Building on this foundation, it becomes especially crucial to devise a detailed financial budget and repayment plan. Borrowers should allocate each sum of money according to their actual income and expenditures, while also setting aside an emergency fund to handle unforeseen circumstances. By keeping accurate records and regularly reviewing income and expenses, borrowers can quickly identify potential financial risks and adjust repayment plans as necessary to ensure a stable cash flow and timely loan repayment. Such organized and methodical financial management not only reduces the overall debt burden, but also provides borrowers with the flexibility needed to navigate unexpected economic fluctuations. The advancement of modern financial technology has introduced numerous convenient tools for managing loans. Many banks and financial institutions now offer services such as automatic repayment reminders, real-time bill tracking, and personal credit monitoring, enabling borrowers to monitor their repayment status and credit condition at any time. With the aid of smartphone apps and online budgeting tools, individuals can gain a clearer understanding of their monthly repayment progress and outstanding debt, thereby avoiding late payments caused by oversight. Additionally, routinely checking one's credit report helps to promptly identify and correct any errors or unauthorized loan activities, protecting one's credit rights. Risk prevention is another crucial component of effective loan management. Before borrowing, individuals should thoroughly evaluate their repayment capabilities and avoid impulsive borrowing driven by temporary cash shortages. Sound borrowing decisions require not only attention to low interest rates and attractive terms, but also a comprehensive consideration of long-term financial stability and future funding needs. For those with unstable incomes or pre-existing debt burdens, it is often more prudent to reduce borrowing amounts or seek short-term assistance from friends or family rather than opting for high-value loans. Since taking on multiple loans can lead to escalating debt and chaotic management, consolidating loan channels and products, or choosing an all-in-one comprehensive loan service that simplifies repayment while lowering overall costs is a strategy that merits serious consideration. Furthermore, a thorough understanding of and cautious approach to signing loan contracts is essential for protecting one's interests. Before entering into a contract, borrowers should carefully read all the terms, particularly those concerning interest rates, fees, penalties for default, and repayment deadlines. If any clause is unclear, consulting a professional is advisable to ensure that every detail is fully understood and that the terms align with one's financial situation and risk tolerance. Only by having a comprehensive grasp of the loan contract can borrowers effectively prevent unnecessary financial disputes and legal risks arising from information asymmetry. In cases of multiple or large loans, borrowers should focus on streamlining their loan strategies. Avoiding the simultaneous use of several loan channels is key to preventing overwhelming repayment pressures that could lead to a debt snowball effect. By consolidating borrowing projects, optimizing repayment terms, and selecting more favorable loan products, borrowers can maintain liquidity while effectively managing overall debt risk. Effective loan management requires not only discipline and planning, but also a continuous effort to learn and master the latest financial tools and knowledge, enabling one to make rational decisions in an increasingly complex and dynamic economic landscape. In summary, borrowing money is not merely a temporary fix for cash flow issues. It is a long-term financial management practice. By establishing strict repayment plans, utilizing modern financial tools, and thoroughly understanding the details within loan contracts, borrowers can better avoid risks such as high interest rates, accumulating debt, and credit damage. Moreover, by rationally assessing repayment capacity, consolidating borrowing channels, and maintaining regular credit monitoring, individuals can build a solid credit foundation. This approach ensures that while they enjoy the convenience of access to funds, they do not inadvertently trigger a larger economic crisis. Under the guidance of disciplined financial management, borrowers can meet their immediate cash needs and simultaneously pave the way for future financial endeavors, achieving both efficient fund utilization and long-term financial health. As borrowing management practices have improved, people have gradually come to realize that unchecked borrowing can trigger severe chain reactions. Many borrowers initially take out loans merely as a stopgap for emergencies or short-term cash flow issues. However, without proper budgeting and risk assessment, these debts can silently accumulate into an overwhelming financial burden. What begins as seemingly insignificant small loans can quickly spiral into unmanageable long-term debts as high interest rates and late fees compound over time. Moreover, when borrowers juggle multiple lending channels simultaneously, the cumulative effect of increasing debt and interest charges can easily lead to a vicious cycle of debt snowballing, ultimately undermining personal quality of life and seriously disrupting the normal functioning of household finances. The consequences of such debt accumulation extend beyond the economic realm, exerting a lasting impact on personal credit records and future financing opportunities. A decline in one's credit score can impose higher barriers and less favorable conditions when seeking future loans, potentially causing individuals to miss out on important opportunities, such as buying a home or a car. In more severe cases, borrowers who fail to repay on time may be forced to confront legal actions, asset seizures, or enforced collections, transforming funds originally borrowed for emergencies into a heavy burden that affects both their personal and professional lives. At the same time, the psychological stress associated with improper borrowing should not be overlooked. Faced with ever-growing debts and mounting repayment pressures, borrowers often experience anxiety, insomnia, or even depression. Financial hardships can leave individuals feeling lost about their future, and this emotional strain may further impair work performance and interpersonal relationships, creating a self-perpetuating cycle. Over the long term, the impact is not only financial. One's physical and mental well-being may also suffer significantly. On a broader societal level, imprudent borrowing can precipitate more widespread economic problems. When a large number of consumers become mired in debt, the overall risk level in the credit market rises. Financial institutions may then tighten lending conditions, which can affect the overall liquidity and stability of the economy. In such circumstances, regulatory authorities often need to step in, adjusting interest rate policies and enforcing stricter loan review mechanisms to mitigate systemic financial risks posed by excessive borrowing. However, the lag in regulatory measures and the inherent complexity of the market mean that uncertainty continues to loom over this issue. To avoid falling into a debt crisis, borrowers must conduct comprehensive and objective risk assessments before borrowing and strictly adhere to what they can realistically repay. Rational borrowing, living within one's means, and establishing a robust financial budget are all critical tools for risk prevention. Only by fully understanding the loan terms, carefully calculating all associated costs, and setting up contingency plans in advance can borrowers build sufficient buffers to weather unexpected challenges and prevent a breakdown in their cash flow. In addition, regularly reviewing one's credit report is essential to ensure that no errors or oversights further damage creditworthiness, thus preserving the ability to secure reasonable financing in the future. In summary, the cascading risks and long-term repercussions of imprudent borrowing serve as a stern test of a borrower's financial management skills and pose a significant hidden risk to the stability of the entire financial system. Only by fully recognizing these risks and engaging in sound planning and strict management can borrowers truly harness the benefits of borrowing as a financial tool while avoiding an endless spiral of debt. Proper borrowing practices not only foster the healthy development of an individual's financial situation, but also contribute significantly to the stability of the overall credit market and the sustained prosperity of society. With the deepening of borrowing management and risk prevention measures, the future lending environment is evolving toward greater regulation and transparency. In this process, not only must borrowers continuously enhance their financial management skills, but regulators and financial service providers are also actively exploring ways to build a healthier, more stable lending ecosystem. The coordinated efforts of all parties will boost market safety and trust, effectively mitigating systemic financial risks that arise from imprudent borrowing practices. Regulators are steadily refining relevant laws and regulations while ramping up efforts to crack down on high-risk lending behaviors and illegal fundraising. Measures include raising the standards for loan approvals, enforcing stricter requirements for information disclosure, and imposing severe penalties for overdue or defaulted payments. At the same time, financial institutions are advancing their risk control technologies, leveraging big data, artificial intelligence, and blockchain to conduct comprehensive assessments of borrowers' credit profiles, repayment capacities, and potential risks. This top-down, multi-layered regulatory framework not only curbs excessive borrowing at its source, but also enables swift intervention once risks surface, thereby safeguarding the stability of the financial market. Fueled by technological progress, the widespread adoption of fintech is providing borrowers with a host of convenient and efficient management tools. Services like smart accounting apps, automatic repayment reminders, and online credit report access help borrowers keep a real-time handle on their financial status, effectively preventing oversights that might lead to missed payments or mounting debt. Meanwhile, through data sharing and risk alert systems, financial institutions can detect unusual transactions and early signs of potential defaults, allowing them to intervene before issues escalate. This deep integration of technology with sound management practices empowers borrowers to plan their finances more judiciously while establishing a robust risk prevention framework across the lending market. At its core, borrowing is a two-way choice, testing not only the borrower's financial planning and sense of responsibility, but also requiring lenders to accurately assess and manage market risks. In this dynamic, consumer education is crucial. Financial institutions and regulators should work to enhance public financial literacy, helping borrowers understand the advantages and drawbacks of various loan products and recognize the hidden risks behind attractive low interest rates and minimal entry thresholds. By disseminating sound borrowing principles through multiple channels, consumers can be encouraged to adopt a budgeting mindset that promotes spending within their means and careful financial planning, leading to more prudent decision-making when funds are needed. Furthermore, as the socioeconomic landscape evolves, borrowing needs are becoming increasingly diverse and personalized. Different groups facing financial demands related to daily living, entrepreneurship, education, and more tend to choose distinct borrowing avenues. Consequently, the financial market is trending toward greater product diversity and more tailored services. The continuous emergence of specialized loans, flexible repayment schemes, and customized financial offerings not only provides consumers with more options, but also raises the bar for borrowers' financial management capabilities. In response, borrowers must learn to compare and discern among the various products available while maintaining sound financial management after borrowing to ensure long-term repayment plans aren't sacrificed for short-term convenience. Ultimately, a robust lending ecosystem depends on the collective efforts of borrowers, financial institutions, and regulatory bodies. Borrowers must continuously improve their financial literacy, carefully assess their funding needs and repayment capacities, and avoid falling into long-term debt traps driven by impulsive or short-sighted decisions. At the same time, financial institutions should, while expanding their business, bolster risk management and customer education to ensure every loan is granted on a basis of transparency and sound evaluation. Regulators, for their part, need to keep refining laws and intensify market oversight to foster an open, fair, and secure financial environment. Only through such coordinated efforts can borrowing serve as a positive tool for economic development and personal financial planning rather than transforming into a threat to social stability. Looking ahead, the lending market will increasingly rely on technological innovation and enhanced information transparency to elevate service quality and risk control. Continuous upgrades in automated risk management systems, along with growing consumer awareness of credit management, signal the dawn of a more rational and healthier lending era. Borrowing will evolve from merely a short-term fix for immediate challenges into a carefully considered, scientifically planned approach to long-term financial management. In this new model, each borrower will take the helm of their own financial well-being, while financial institutions and regulators, armed with greater efficiency and tighter measures, collaboratively steer the market toward a more open, transparent, and resilient future. Through the combined forces of technological innovation, stringent regulation, and robust public financial education, there is every reason to believe that the future lending environment will be safer and more efficient. Borrowers will enjoy flexible financial support while avoiding risks from mismanagement. Financial institutions will achieve a win-win balance between business growth and risk prevention, and the overall financial market will provide strong support for sustainable economic and social development. It is precisely through this comprehensive, multi-layered collaboration that the lending market is poised to enter a new era, one that is healthy, transparent, and dynamic.
The English Pod Audio Review. Listen to the meaning, then say the vocabulary word. A steep and rapid fall. Plunge. To contribute, especially in a discussion. Weigh in. Affording gain, benefit, or profit. Profitable. The amount of something that is produced. Yield. Take another look at something. Think outside the box. Let's try that faster. To contribute, especially in a discussion. Weigh in. Affording gain, benefit, or profit. Profitable. Take another look at something. Think outside the box. The amount of something that is produced. Yield. A steep and rapid fall. Plunge. Now say the word and hear it in a sentence. Plunge. The prices of houses in the US took a huge plunge this month. Plunge. The car went off the road and plunged into the abyss. Plunge. The value of our stock has taken a major plunge. Weigh in. Carol usually weighs in with good ideas at our meetings. Weigh in. Many factors weighed into our decision to fire you. Weigh in. If you weigh in all the pros and cons of buying a new TV, you would see that we don't really need it. Profitable. Their business is very profitable. Profitable. I think we can be profitable if we reduce our operational costs. Profitable. Real estate is one of the most profitable businesses in the world. Yield. The stock you currently own yields about 10% per annum. Yield. I am very unhappy with the yield of these securities. Yield. The yield on your securities could be greatly affected with inflation. Think outside the box. When you have to solve a problem, it's good to think outside the box. Think outside the box. Some of the great inventions of our time were invented because inventors decided to think outside the box. Think outside the box. Thinking outside the box can offer a different and novel perspective on things and life.
Thank you for tuning in. We hope you found this episode both insightful and enjoyable. Don't forget to subscribe so you never miss any great episodes. See you next time.